have incremental underwriting systems. We don't have really easy ways for an advisor to deal with the existing insurance provider to put increases in place. Now, there are some limits on some policies, yes, admittedly, but if I want to do an increase of 20 or 30% for a client's IP because I got the big promotion at work, I'm back to doing the full application process, the full underwriting piece. Why don't we have things like incremental underwriting? I underwrote the client 4 years ago. All I need to do is update their health history in the last 4 years. Why don't we have things like that that bring efficiency to the practice? I think that's part of what we've got to get on the table, and this isn't going to be resolved, John, I'd suggest in the same time frame, but we need to commit to the discussions of how we bring this stuff to get efficiency for our members of the AFA.
And you have put those on the table. Yep.
We have another question over here.
Hello, John, and the rest of the panel. Philip Young from Australian Financial Risk Management. John, for your information, we have for the past 14 years written what's classified in the industry now as hybrid. I don't know whether we had anything to do with it, but I can tell you that in the first year we are exactly like an insurance company. We don't make profit from the systems and processes of giving advice under a hybrid model. We make our profit like an insurance company with retention. So I would be very concerned if it was over a 3-year period on a hybrid system because we'll go broke. We have 30 families. We have employee advisors. And I think the members of your Financial Services Council have got to get their act together. They've dug the hole and created the problems. The lapse rate that you're talking about is a guesstimate. Well, I can tell you from the interest that has been shown since you've released this proposal is that a lot of insurance companies are coming to us talking about lapse rates. And one particular bank-owned insurance company came to me recently, as 3 weeks ago, and they were talking about the significant lapse rates. There was a trauma claim paid. There was a death claim paid. There was an income protection policy that ceased because of the client being deceased. There was businesses that had gone broke because of the global financial crisis. There was also the instances where we actually changed for the client's best interests and moved the client's business from one company to another. And why was that? Because the insurer had bought an insurance company and had increased significantly the rates in that book of business. We also are faced with the situation where we have books of business that are closed. So when we have to do increases, that also occurs as a lapse rate. I think the members of the Financial Services Council should not guess, because all of the information we get on a monthly basis with regard to lapses, we have to go through them thoroughly to make sure that they're accurate, and they're not. So the information you're getting from your members is not accurate, and until we get accurate information, as Brad said, quite rightly, and the others on the panel, we can't really make good decisions.
Thank you, and I hear you on hybrids.
I have another question from the webcast, and this one I think is particularly interesting. Why does Bill Shorten want this fixed by the industry, or he'll legislate? Who or what is driving him?
Well, all you've got to do is look at FOFA. I mean, the clear intent of FOFA, as Simon and I said, is meant to be about reducing conflicts and increasing advice. The availability of advice, we think it will... I mean, Simon had one comment. Is there more independence? Well, the clear fact is there's been a greater consolidation. So, and we told that. I mean, some of you may have been there. We had an extraordinary meeting with the government a while ago and I said to them across the table, you are going to force consolidation. Are you happy with that? And just to give you a flavour of the sort of negotiations we dealt with, they described the independent fan sector as marginal. It's a marginal industry, and which is code for it. It depends on volume rebates, and it would fall over if not for them. That's what they think of the IFA channel. So they don't really care in that sense. What's driving it is the zero commission world. I mean, to some extent, and here we are, you know, we're at a different point in this, but to some extent, it's a miracle that we still have commissions in life insurance, because it's no commissions on super, no commissions on investment, ... And we were lucky that they didn't put a no commission on insurance. Why? Not a person in this room thinks that that won't be devastating to the industry, but I'll tell you what, it looks good on the front page of the Telegraph or the Herald Sun. And we in here, I mean, I challenge defending 120% upfront commissions on the front page of a tabloid. Can you do it? I can't. So that's the problem. Sorry?
It shouldn't be there. Why would a product manufacturer make a product and give it to a distributor and give that distributor more than what the profits were?
Oh no, can I?
It doesn't make sense.
Can I just have an answer on this one? The average life insurance policy sold through the advice channel is around $2,500. So the commission in the first year only is actually around $3,000 odd. If you sell or give advice on a superannuation plan for someone of say 500,000, the fee is around 70 basis points, slightly more. So let's not get too fact-free in the debate. The actual amount of commission, when expressed in the long term about all the premiums that are paid, plus CPI, etc., are actually relatively low. If you go to direct insurance, which everyone wants to talk about today, the average acquisition costs are around 25% of the premium on a level basis. Level commissions are 30%. That is not much of a difference. The cost of acquisitions for insurance, it doesn't matter what channel, if you go to Geico in the US or Allstate in the US, their distribution costs on the internet are around 28% of premium because they have to spend so much on brand to keep it up, to keep it in front of the consumer's face. The point about insurance, it's sold, not purchased.
But just to finish my point, the question is, why is the government pushing this? You know, we've had to argue just to justify commissions, full stop, on insurance. Because, back to the point about regulate or will regulate, I mean, we had the alternative put on the table and it wasn't far away from what Simon talked about earlier.
I think the other point there is, remember, the commissions are effectively a capital arbitrage between the insurance company and the customer, right? If there are no commissions and it was just a direct thing, a fee payable to you by the customer, that would double the premium, obviously, right? So the cost of capital to the insurance company is clearly lower than the cost of capital to the consumer, and that's why we have commissions. Explaining it to politicians is really, really difficult, okay?
Brad Fox.
Yeah, I agree with that point. Look, I think just a couple of things. John, you've been extremely gracious in coming and fronting a difficult topic. I've got to say that the FSC's engagement with us since their announcement and even prior to their announcement has been very, very strong, and we're appreciative of that. It is an important issue. There is a partnership element that we've all mentioned, and we do need to get it right. And I speak very directly to our members now. The FSC are listening. And my instinct is we will end up with a solution that we can all support. We have not just a changing environment, but we have an environment that is changing at a rapidly faster rate. Whether it's FOFA, whether it's the digital age and all those things combined, the rate of change we're facing as advisors is enormous. And we do need to adapt. Now, the AFA, we are going to take a leadership position on this, and I think we have been clearly demonstrating that already. And I think the FSC are listening, and I'm pretty confident that we'll end up with a solution that we can share, we can live with, and the balance will end up right between who's carrying the cost around the sustainability of insurance. But I think we do need to be prepared in advisor land to make sure we're assessing how we can change our practices so that we still have profitable, sustainable businesses. Otherwise, we're no good to our clients. We need to keep putting our clients first, and we need to be aware of best interest duty and what that means in a change of policy provider situation. But more than anything else, if we just pretend that we don't have to change anything, we're getting it wrong. There is going to have to be some change. And we're just going to have to get the policy settings right, that every piece of the value chain is sustainable, not just the big end of towns.
Simon?
Look, I'd also like to applaud John and the FSC for the consultative way that they've gone about this. It's been a genuine consultation process, and I think that'll lead us to a good result. We've been enthusiastically involved in that consultation process, and we feel like our voice has been heard. Look, we're already seeing consolidation in the dealer group space, and I think the last thing we need to do is to see that carried on into the advisor space. It's going to be interesting to see when the music stops how many licensees are left there, and the challenge for those licensees will be to support the inevitable change that Brad talked about that advisors will have to go on, and that'll be the challenge that Guardian will take on, as well as continuing to be involved in this debate actively.
Don Trapp?
Look, I agree totally with what's been said. The FSC engaging with advisors through the AFA and the FPA, we've got to applaud that. There's no question about it. My concern, however, is that the only panacea that seems to be put on the table is the lever that pulls insurance advisors. There's no panacea being put on the table which says, as an industry, life officers need to change also. We need to change something that we do as a life insurance company is not being put on the table. So the only cure-all, the only antidote for all our ills is the poor advisor. It was said earlier by one of the earlier speakers that they've been through FOFA, they've been through FSRA, and now they're going through this. I mean, four-letter acronyms, insurance advisors hate them. Because every time a four-letter acronym comes out, it hurts the advisor. They're in the target and in the crosshairs. For once, can the insurance companies please, physician heal thyself, I think, is the expression. Look within yourselves and say, what can we do as an industry to change what's happening, rather than look directly to the advisor as the only panacea that's out there.
Don, I think there are some four-letter words that come to mind as opposed to four-letter acronyms when we think of what's happening at the moment in FOFA, etc. But look, you guys and Brad and Richard and the FPA have put other issues on the table about in the administrative sales world that we're listening to as well. So we get that point. We get that we've opened the door, and we just can't close it on our terms. We understand that. So there are some other issues that have to come into play. And you're right. We're operating in an environment where most people. I mean, we're always going to have the right to underwrite. We're not health insurance. We're not socialised, so we have to have the right to underwrite. But you turn on your TV when Richard's home on the lounge at 11 a.m. You turn on the TV, and you can get whatever you like for $100,000. So and some people run both channels, so and they're my members. So there is a conflicting message out there. Now, equally, that's making markets. For some people, they think $100,000 is a lot of money, and they think that premium is what they can afford. For a whole lot of other people, it's not enough money to survive on if they get hit by a bus this afternoon. So there is market making and market messages that's going on. But if the message here is no medical test, which is no testing, which is our word for no underwriting, if that's the message going here, there's probably an increasing gap between non-underwritten and underwritten, which is a challenge. And I know personally, and I won't go into details, but one of the areas we as an industry have to particularly improve in, and I know this is a live issue for advisors, is particularly in mental health. I mean, it's not as black and white as it used to be. It gets better all the time in terms of understanding how it works. But we've been slow as an industry to catch up on distinguishing. But if somebody visited a psychiatrist 3 years ago, I don't reckon that's a good reason they get knocked back for a decent life insurance policy. And we're a bit out of step with that, and we're moving forward as quickly as we can.
Just to add to that, a little bit of complexity, because there's been no complexity so far this morning. If you think about direct insurance, also understand that direct insurance fundamentally is more expensive than advice-based insurance. So don't see direct insurance as a competitor to advice. It's actually a fundamentally different product that looks after a different segment. And the reason direct insurance is more expensive than advice-based insurance is because you take the effort to take people through the underwriting process, and in doing so you get better selection of lives, and therefore you can charge a lower premium. So this whole discussion is a very complex issue, and we need to actually take the time and understand the impacts. We don't want to end up in the FOFA stuff up, where you actually end up reducing the amount of advice available to Australians and reducing the independence of advice given to Australians.
Okay, well, thank you to everyone. I think we have one more question out there. Yep, if you could ask your question, because this will be the last one, I'm sorry, because we're coming to the end of our time.
Okay, Peter Corrie. I'm an advisor, but FOFA and the Labor Party have done a brilliant job in being a threat to our industry. There's no doubt about that. The 3-year commission period is also a huge threat. There's no doubt about it in my mind. And I go back to the 70s and 80s when they had a 2nd-year commission right back, and that was devastating. It was a diabolical failure. There were so many people went out of business, it wasn't funny. Now, to bring that in, I think you've really got to ask yourself a lot of questions. So what my question is, what makes you think this is going to work?
God, I hope you're not asking me. Let me give you some of the consequences, because I think that is the important piece of it, right? So let's just say, for argument's sake, there's a 2 or 3 year responsibility period. I know what the response is going to be because I've seen it in other countries. You'll end up having advances against commission, because at the end of the day, the cost of advice is the cost of advice. It's going to cost you at least, and including a profit margin, which every advisor should get, around $3,000 to give advice to a customer. You've got to do an SOA, do the fact find, all the rest of that kind of stuff. So all you're going to end up in some other financing model. I think the importance of the issue that we're trying to get through today is to actually have a decent conversation about it, so we actually increase the knowledge around the issue. At the end of the day, you cannot expect someone to give $3,000 worth of advice for $2,000. That makes no sense at all.
The ultimate test will be the ability for this to push down the cost of premiums, because we've talked about it a bit, but we do have to remember, and I think, Scott, your research showed this, and correct me if I'm wrong, people think it's expensive. Was that part of what?
I wasn't showing it here, but I have seen that in prior research.
Yeah, so Scott said he didn't show that here, but he has seen it in prior research. People do think life insurance is expensive, and that's the ultimate objective. We have to get it to make it more affordable so more people can get it.
With asking supplementary questions, can we just wait on the microphone, because
Here it comes,
this
just
is
behind
helpful
you.
for
The check's in the mail,
webcast.
okay? Keep calm.
I don't think clients do think life insurance is expensive, and even if it is, it's all based on need. I mean, if you can sell the need, they will take it. They don't care what the price is, to be honest. I mean, I saw a doctor the other night. He put in X amount of dollars a month. If I had have doubled that, he wouldn't have flinched.
Yeah, that's because he's a doctor.
He charges
be honest.
too high a fee for service.
Yeah,
That's his problem.
That's because he's a doctor. I mean, I don't know what the bloke who washes his car's doing, but we need him to be covered as well. Have you?
Any comments from this side of the floor?
Go on, Don.
Look, Peter did talk about history. Now, historically, Peter's right. Back in the 1970s, there was actually a 3-year responsibility across the industry. Back in the 1980s, no, that was the 70s, Peter. I actually do go back to the 60s.
That's when Don was 50.
And you were born then. Sorry, Simon. In the 80s, it had pulled itself back to a 2-year responsibility, generally 100% in the first 6 months, proportionate thereafter. Some companies still 100% in the first 12 months, proportionate thereafter. And Occidental came along and basically ripped the market apart and said, we believe 1-year responsibility is the way to go. Australian Eagle followed fairly quickly after that, and as did Legal and General and Friends Provident, names that don't even exist anymore, do they? In those days, we had 50 life insurance companies. Look at Stone and Cox, which is the book I've got in my office, and there's 50 life insurance companies listed in that era. It was competitive practices that actually drove the responsibility period from 3 years to 2 years to 1 year. It was competitive practices that did that. Now, John let a genie out of the bottle in his opening remarks about the ACCC. This is probably now an appropriate time to raise that. It was a good segue, I thought. If it was competitive practices that actually drove our responsibilities from 3 years to 2 years to 1 year, and there is collusion amongst players in the industry to reverse those competitive practices, I believe the ACCC would be interested in something like that. And the only test is not, is it good for the consumer? That is not the only test. Because if that was the case, all sorts of things could be put through legislation, all sorts of things could be put through associations under the heading of best practice. It's good for the advisor, or good for the client, I mean, but where's that leave the poor advisor? If the advisor is prejudiced against because of an anti-competitive practice, I believe that is something that our industry is above, and we shouldn't be doing it. If one life company wishes to come out and in the competitive market be brave enough to say, we would like to change our remuneration model. Our new remuneration model is a 2-year responsibility. A trade-off is we might give you more commission up front or more commission down the track, some sort of trade-off. Then that's not anti-competitive. But to turn around and collude, it's the only expression I can use, collude, with a group of life insurance companies through their own association to introduce an anti-competitive practice, that is just wrong. And that's history.
Okay, and with that note, which could actually lay the foundation for our next breakfast, and it would be just as animated, I believe, I would like to thank our panellists, John Brogden, Brad Fox, Simon Harris, Don Trapnell, Simon Swanson, and of course earlier Richard Clippen and Scott Graham. I hope you found this morning informative. My apologies to some of the people on our webcast. There were quite a number of questions that came up on my digital iPad and which were in some ways covered off by the answers and discussion that occurred on the panel. So once again, thank you very much for attending. As a heads up for any of you who are interested, Money Management in October, I think October 4 is running an education series on asset allocation, not nearly as sexy as life risk, but worth attending anyway. So thank you very much, everyone, and please give a round of applause for our panel.